everything about accounting just clicked for me. It made total sense. And then at the time, I found out that UConn's accounting program placed 100% of their students with jobs coming out of college, and finance was more like 60%.
Oh,
I was like, okay, I want a job. So
Yeah.
I'm going to switch to accounting. It seems easy, makes logical sense for me, and I know I'll get a job. And then I never went back. I kept doing my accounting courses. I took my first finance course and ironically hated it. So it was a good decision. So immediately switched into accounting.
Excellent. For those of you just joining us, this is Jason Correa with CLA. We're catching up with him about how he got into the accounting world, and we're going to hear a little bit about quality of earnings reports and how and when you might need one. As we look towards kind of those topics, what did the rest of your journey? You get your first job, accounting. Most of us think about who we take our taxes to.
Yep.
So this is not that. This is a different type of accounting.
Yep.
So what led you from I need to get a job in accounting to where you are now?
Yeah, and I started in a more traditional role doing auditing work. Started with a firm called Bloom Shapiro. I was with Bloom for 10 years before we merged into CLA, and started doing more traditional like financial statement audits for private businesses.
And when would somebody need an audit?
Typically because they have some sort of bank debt. So they have a requirement where they have to provide audited statements to their bank at the end of the year. We do a lot of work for a lot of the like municipalities in Connecticut as well. So they have, they have their own kind of responsibility to submit financial statements. Same with a lot of like the nonprofits and schools. So I did some of that work. It was a great foundation and base for me to build up knowledge, but it certainly wasn't like a passion of mine. And then I moved up to the Boston area, maybe about 2 to 3 years into my career. And when I got up there, started doing some work with the search fund community coming out of Harvard Business School, their entrepreneurship program. And as soon as I started doing that work and helping support them with their acquisitions, I fell in love with the work.
So for anybody that doesn't know what a search fund is, a search fund is when you are looking or searching for a business to buy yourself.
Yep.
They're normally smaller businesses. So some of our owners may sell to search funders, and they're essentially buying the business to operate from a starting point that's pre-existing driving profit.
Yep. Yeah. So these were mostly people in their early 30s, right, who had like an initial career in Wall Street,
Right.
then went back to Harvard to get their master's, to get their MBA, came out of Harvard's entrepreneurship program, and like you said, did a search to find an existing business that had an owner that was looking to transition where they could take it over, own and operate it, and continue to grow it. And HBS at the time had a great model where the two main professors who started that program would kind of pick their top students every year and invest and support them. And so we would work directly with all their top students
Fabulous.
and just do the actual quality of earnings work, support them on the transaction, then afterwards help them with the actual accounting work for the business so that they could report to their investors. So that's how I kind of got my foot in the door doing this kind of M&A work. Loved the kind of pace of it, that it was something different all the time. It was exciting. I didn't mind that it was like more pressure and
Not everybody does well with pressure.
no, there are certainly some people on our team who, wasn't a good fit for. But I enjoyed and still enjoy the fact that it is like a new challenge every day and you're always being forced to learn and expand your skills and adapt. It felt like I would have gotten very bored and kind of stagnant if I had stayed doing financial statement audits for the same clients every single year. Like it didn't feel like that would have been a mental challenge for me.
Way back when before I found M&A, I was told, "Oh, you should go into the business world. You'd be great in the business world." And that was my worry.
Yeah.
That it was going to be the same thing every day.
Yep.
And I was just going to be bored out of my mind.
Yep.
No, mergers and acquisitions are not boring.
No, certainly not. It's certainly not the same thing every month, let alone every day. So,
every hour can be a different task.
Yep.
So quality of earnings, we generally, as a sell side advisor, say to certain size businesses, you should have this done before we go to market. You should know what it's going to adjust out to.
Yep.
And in preparation for that, one of the things I did was I went and took a course on quality of earnings. I left that course knowing as much about quality of earnings as I did when I walked into it. So
I didn't even know those courses existed.
Yeah. I wouldn't recommend that particular one.
Yeah. Okay.
But tell our owners that are listening kind of what is a quality of earnings better than that class did, please.
Yeah. I mean, ultimately, a quality of earnings is meant to be an exercise to really verify the accuracy of your financials, understand like the cash flow and earnings that the business is really generating, and more important than anything else, like we always say, normalize those earnings to ultimately show like what would the business look like on a go forward basis.
What do you mean when you say normalize? I feel like that's maybe the largest hang up that our owners run into.
Yeah. So, when I talk to business owners, I try to draw the distinction of, they're operating the business as a sole owner. It's a private business. So there are certain things that they may be doing that if someone else came in and bought the business, they may not do anymore, right? Things like they may be paying themselves or family members a certain wage, again, because it's, their business. A lot of times they're running their business to manage their taxable income, right? They're trying to limit the taxes they pay. That doesn't mean that it's actually reflective of how much profit the business really makes. So when you're trying to present to somebody who's interested in buying the business, we say normalize. We want to show what the actual cash flow and earnings are that the business is making, not what the net income is on a tax basis, because those can be two very different things.
Definitely. And what, when you're normalizing, one of the things that I see as a challenge is many businesses, despite size, run on a cash basis.
Yep.
And a buyer or even a banking or lending institution is going to anticipate seeing things on an accrual.
Yep.
So tell us real quick, what am I talking about? What's the difference?
Yep. Yeah. And like you said, most business owners, because they're really running their business based on what they're going to pay for taxes, are really focused on the cash flow of the business, meaning when am I getting paid by my customers? When am I paying my vendors? And how much cash do I have in the bank account?
Can I pay payroll today?
Right. That is very different than what you have actually earned for revenue based on the services or goods you've sold and what you actually owe as liabilities to your vendors or to your employees. So when we talk about doing that cash to accrual conversion, it's understanding, is your business growing, but you haven't collected all the cash yet because you have outstanding receivables from your customers, which most companies do.
Correct.
And are there certain liabilities that you haven't paid for, but you technically owe? You've gotten invoices from your vendors, or you owe your employees a bonus,
right?
Or profit sharing at the end of the year, but you're not going to pay it until March 15th when it's due for tax purposes. So again, it's part of that exercise to present the financials in a way that a lender or an investor would expect to see them, consistent with kind of generally accepted accounting principles.
Yeah. And we hear the word GAAP all the time,
Yep.
which is generally accepted accounting principles. And I've even heard a CPA say, oh, yes, my client's financials are on GAAP. And then I look at them and I go, no, they're not.
Yeah. The term can be used very loosely sometimes.
Right. So, and when you're preparing your taxes, even if you're getting a prepared financial report from your CPA with your tax prep, nobody is checking that you're on GAAP. There's no red pen happening on these things.
Yep.
Because the government just cares that you paid your taxes.
Yeah, and certainly right now with the with the amount of people that the IRS has,
Right.
I think they have bigger
issues.
Right?
Absolutely. Yeah. Absolutely. So, operationally, you can be just fine. And we see many owners bank a set amount of cash,
Yep.
right? So they never have to worry about, am I going to pay payroll? And I was working with one client, and they said, oh, we were talking about accruing the investment and why, you generally spread it out over the months.
Yep.
And it was a substantial amount that they just deposit into the 401k plan. And I said, so how have you made that payment every year? And the CFO goes, I just wrote the check.
Yeah.
And I was like, well, it's good that you've always had the money.
Yep.
And he goes, I never thought about that.
Yeah.
And I was like, oh, okay. So it's those kind of differentiations
Yep.
that are just not how you operate your business on a daily basis. And I say this all the time and we'll pivot to working capital here for a hot second, because that's another
Yep.
another point of education. You never, in any point of operating your business, need to stop ownership on one certain day.
Yeah.
And have it somebody new own it the next day.
Right.
That's not an operating feature that's generally in place.
Yeah.
Until you go to exit.
Yep.
And whether you're doing an internal transfer, an outright sale, bringing in a partner, ESOPing, any of those, you're going to have to draw a line in the sand, which if anybody's been to the beach, it's not easy to do.
Yep.
So there's a structure that we refer to regularly, which is networking capital.
Yep.
So talk for a minute about what that looks like.
Yeah. And to your point, that's something that when you bring that up to a business owner who's never been through a transaction before, they usually look at me like I have four heads, because that's not a concept that they think about in running their business. No. But the intent behind it is to understand what the actual capital needs are of the business. So it's really, in short, it's really understanding what the cash cycle looks like for the business, right? How quickly are they typically collecting their receivables from customers? How quickly are they paying their vendors? So it's understanding how much capital there needs to be, so that if we're talking about a manufacturing company that's making widgets, it's from the time that they order their materials and have inventory, what does the cycle look like for them to actually sell and convert that inventory into revenue and then convert that into cash, versus the time cycle of when they placed an order with their supplier and have to pay for those materials. Because ultimately any buyer is going to be looking at that and going to want to understand, is this a company that, to your point earlier, that CFO that always has enough, cash and capital that they're not going to be worried about paying payroll. They're not going to be worried about funding, profit sharing. Or is this a company that has such a tight cash cycle that we're going to have to use debt in the line of credit to fund operations sometimes? That makes a really big difference in how a buyer looks at a business.
Because
and
what they
kind
have
of
to
value
bring to the table, right?
Because it impacts their leverage on the deal. So it makes a huge difference on how they model it out and kind of assess the value.
Yeah, absolutely. It's a sticking point in every, and there's only 1,000 different ways to calculate that. And that makes it a little harder. Yeah,
it's something that is absolutely not black and white. Everything about it. There are a lot of gray areas, so it is definitely, as you know, one of the areas that ends up getting negotiated ad nauseum.
Heavily.
Right? When you whether up front in the LOI or certainly once you're working towards the purchase agreement at the end, because there is no just strict formula that you follow every time for working capital.
No. Yeah. Even though they say there is.
Yeah.
Every buyer says, oh, this is the way it's always done.
Yeah.
And every one of them, I'm like, I've never seen it done the same way twice, right?
Yeah, exactly. It's always a little bit different.
Well, it makes sense. Like all of these things being specific to a business makes sense because every business was formed and operated differently.
Yeah.
Because a different person, a different task, a business that's been operating for 100 years is going to have a different set of processes.
Yeah. I mean, fundamentally, one of the simplest analogies I usually make for people when I'm trying to explain like what we're trying to accomplish with our quality of earnings, again, because most people, even if they haven't sold a business, have bought or sold a house, is, if you're trying to sell your house, you wouldn't just show people pictures of the house and be like, okay, here you go. Here's what it looks like. Although some people do that now and say, buy it as is. Most buyers are going to come in and hire a professional to do an inspection.
Correct.
Right. That's what a buyer is going to do. They're going to do a quality of earnings to actually inspect your financials and make sure that everything you've told them makes sense.
They want to see that all the light switches work and the plumbing isn't leaking.
Right. So like you said, we do this a lot more on the sell side in advance now to get ahead of that. So there are no surprises when a buyer comes to the table. And hopefully we can identify those little things that need to be fixed or tweaked to say, okay, yeah, we're gonna put some new paint on this.
Right.
We're gonna fix that light switch. And now it's not something you're gonna have to negotiate with a buyer about. You'll be able to get top value for your business because of it.
Right. Well, and having a third party come in like CLA and do the quality of earnings versus we look at stuff internally and try to kind of fix the light switches ahead of time. So there's a level of business that we refer to you, to people like you to do this. What's the magic number on when a size of a business should consider a quality of earnings report?
Yeah, I mean, I think, as a firm, we do a pretty good job of, I'd say, applying a flexible approach to it where we can scale up and down our work to be practical for what's needed. Now, with that, I'd say, we're typically working with businesses that are, on the low end, maybe 1 to 2 million of EBITDA, and then on the higher end, anywhere from 10 to 20 plus million of EBITDA. So certainly, if you're a business that's doing 10 million plus of EBITDA, you're going to want a quality of earnings done, even if you're working with an outside CPA. But where we spend most of the time, honestly, is in that like $1 to $5 million EBITDA range, because most of those businesses don't have like reviewed financial statements.
Correct.
They don't have a CFO.
Right.
A lot of them have a controller or a bookkeeper. They're using QuickBooks, they're cash basis. So that's where we can provide the most value.
And what revenue does that translate to? Understanding that many of our owners may not know what their EBITDA is.
Yeah, I'd say, it's anywhere from, probably like 5 to 30 million of revenue is honestly where we spend most of our time. I'd say even 5 to 50 million. Above that size, we still do a lot of quality of earnings on the sell side, but usually those businesses are more sophisticated and have more controls and have a more robust finance team. So it's still valuable for us to come in as an independent third party, but it's more of a check the box exercise as an outside third party to validate what management has already done, as opposed to when we work with smaller businesses, just like, like we're holding their hands throughout the process.
There's a lot of education.
Right. It's a lot of doing the work and then also teaching and educating along the way.
Right. Agreed. So we see a process called rolling forward often. And I just want to real quick talk about why that would happen. Just like every other point of finance, you look at from here to here, and then you stop. But the company doesn't stop, the operations don't stop, and the deal process doesn't stop. And so, what happens when you roll something forward?
Yeah, and especially in the current environment, I mean, our experience of late is that deals are taking longer to get done. So, when we do our initial quality of earnings, like you said, it's up through a certain point in time. And then when we're rolling it forward, it's exactly that. We're updating it and kind of refreshing the analysis and the numbers to be more current with the actual operations of the business, because any buyer is going to want to know, like, it's great. It's great that you presented this historical analysis of what the company did, say through the end of last year. We want to know what it's done so far this year to make sure that you're still on track.
Yeah.
That you're, looks like you're going to hit your budget or your forecast for this year, because the last thing a buyer wants to see is that the business has started to trend in the wrong direction,
right,
or tail off because the owners might be taking their eye off the ball as they deal.
Or macroeconomics have been a problem.
Right. With everything going on right now, right? The potential impact of tariffs, like any buyer is going to want as much information as possible.
Mm-hmm.
So that roll forward is our way of just trying to improve transparency
mm-hmm.
and just give them, up-to-date information.
So we prep our owners in advance to understand that no part of diligence is easy.
Yep.
And that they're going to need a lot of things. Quality of earnings are notoriously difficult. What is an owner going to need to provide you to be able to do your work?
Yeah, it's a lot of data. I'd say, when we work with businesses, in our part of the market, we try to make it as least painful as possible.
Mm-hmm.
So a lot of times, because they're using a basic system like QuickBooks, we'll work with them to just get a backup of their QuickBooks file
mm-hmm.
so that we can get direct access to their data where they don't have to be in the weeds pulling reports for us.
Yeah.
Because we do need to get into like detailed transactions.
Mm-hmm.
We're going to be looking at bank statements and understanding, especially for doing that cash to accrual type
mm-hmm.
of analysis, understanding, what they've actually collected versus what they've billed out. So it's a lot of getting at raw data. And usually if we can get access to their system,
might be easy.
It makes their lives a lot easier. And then we can spend our time, having discussions with them to make sure we understand the business, that
right.
we know it inside and out just like they do, so that ultimately when they start to have conversations with the buyer, I think a big part of the value that we provide is not just doing that analysis and then disappearing, and walking away. It's staying and riding along with them throughout the process
mm-hmm.
so that we can act as a buffer and answer a lot of questions
right.
that come up from a buyer's team, so that it's less weight on their shoulders having
right.
to deal with that process.
Right. So, and that brings up kind of where I was going next, actually. So perfect segue. Thank you. We ask certain people to do sell-side QOVs. Regardless, if there's not a sell-side QOV done, the buyer is going to do one. So the having you along the way and the support is fabulous. We actually had one we're working on together where you spoke with the buyer's CFO and they opted to not do their own quality of earnings. They said, oh, we trust Jason. We trust CLA. He understood it, and that saved time and energy. I think when you're doing a buy-side QOV, it's a lot harder to be like, here, Mr. Firm that I didn't hire, here's access to my QuickBooks.
Yep.
That's a scarier position to put yourself in.
It is for sure. You're right, because you don't have a relationship with that firm whatsoever. If you're hiring, whether you're hiring CLA or a different firm, right, they have a fiduciary duty to, they're working for you. So there's certainly different kinds of confidentiality and things like that make it, I think, more comfortable for a business owner. But yes, if you haven't done any of that work up front, then you're going to, the level of detail that the buyer is going to go into is at a completely different level than if you've shown them that you've made the investment to do a lot of this work ahead of time, to spend the time and money to do it. Then they know that you're really serious about the process. Yeah. So it makes a difference.
Well, and we see owners hesitant to spend the money because it's not free.
Yep.
It's a commitment to do it, time and money. And they're like, oh, we'll wait and we'll do it when we have a buyer. It's going to expand your time.
Yep.
So how long does this process take? And I know that's a loaded question, and you're always tired of me asking you.
And you're right that it obviously depends, but I say in general, we're usually able to get through our work in like 3 to 4 weeks. If it stretches longer than that, it's usually because either we're having to do more work than we expected on that kind of cash to accrual conversion, or there's just delays in getting the information, and then maybe it can take up to 4 to 6 weeks. But that's usually the timeline that we work under. To your point, Deb, like doing that up front can really help with the timeline once you sign the letter of intent. Especially if because you know this, when you're getting offers from different potential buyers, a lot of what goes into consideration is like, what's the certainty to close? Well, if you know that they already have the capital secured and they can kind of run a quick process, and you've done a sales IQ in advance, so you know that that's not going to be, you know, a long pole in the tent for them, that's a big difference versus somebody who has to go out and find the funding or deal with a lender. And by the way, says, yeah, our Q of E team is going to need 6 weeks to do their financial and tax Q of E on the target.
Well, and we don't have a situation always where you can't go get the financing without the Q of E. So you're not going to start, like, these are not commingled processes.
Exactly.
You have to finish the Q of E work before the bank will accept the numbers.
Right.
Then you have to start writing your contract.
Right.
After that, because things could fall apart. And that's the more time in a process from when we have an agreed upon purchase price and structure and all the details in the LOI, the more time there are for things to change, markets to crash, tariffs to be employed, like anything can happen in that amount of time. So the shorter we can keep that time, the better. Which is why Jason knows I'm always like, how soon can I get that? How soon can I get that? Can I get that now? Can you get that to me tonight?
Well, I mean, I think every professional in the deal space says, right, you know, time kills all deals. It's not your best friend to have more time. No. You want as much as it can be stressful having a compressed timeline and having to kind of sprint. If you have that and can keep things on track, again, it increases the likelihood of a successful close, which is what we're all trying to accomplish.
Absolutely. That is absolutely the goal. So as we wrap up here, it sounds like you had an interesting journey into this career. So if you were not doing this, what would you be doing?
So interestingly enough, the only time that I considered pivoting a little bit, and again, still would have been in accounting, but I got my CFE and was very interested in going into forensic accounting and applied for a job with the FBI in Washington, D.C. At the time, my wife was applying to PhD programs, and she applied to Yale and Johns Hopkins. She got accepted to both. So while we were deciding where we were going to go, ultimately move back from Boston to Connecticut, which is what we did, or move to D.C., I applied for a job with the FBI, got an interview, and then she decided to go to Yale. So if I was going to have pivoted, I was going to go down a road of being a forensic accountant, which at the time I joked with my wife. I was like, I'm going to be an accountant with a gun. How terrifying is that?
I don't know that they let them all have guns.
Well, and in hindsight, it probably worked out for the best because there's no way I would have made it through the physical training. Like I would have had to go like actually to Quantico and go through physical training in order to be even though I wouldn't be an actual agent,
right? Like
I would not have survived that. So it's probably for the best.
Well, that's some self-awareness. Yeah. That's good. That's good. Interesting. Yeah, that sounds like a lot of fun though.
Yeah. So safer for everybody. I don't carry a gun. I didn't have to go do weeks of physical training where I probably would have collapsed. So yeah,
that's great.
Worked out.
Well, if you find yourself for our owners at home, if you find yourself in need of a quality of earnings, I definitely encourage you to call Jason at CLA. His information is going to be at the bottom of the podcast, and contact me and I'll get you in touch.
Awesome. Thanks, Deb.
Thank you.